Hi, welcome to my channel. My name is Gil Rossi, investor and funds manager. Today I want to share with you my evaluation of ServiceNow. Let's get to it. Let me show you first the structure of analysis I will use. First, the qualitative portion, which includes past performance of the business, management, competitive advantages, and financial position. Once I am happy with these four attributes, I will go to the quantitative analysis, which includes making the projections and calculating fair value and IRR of the company. So let's start by moving to past performance of the business. Let me first explain a little bit about the company. Their vision is to make the world of work better for people, and they will do that delivering digital workflows that create great experiences and unlock productivity. By the way, workflows is the series of activities that are necessary to complete a task. 80% of the Fortune 500 companies rely on ServiceNow solutions using the Now platform for successful digital transformation. And ServiceNow's aspiration is to be the defining enterprise software company of the 21st century. They have a few different products. One of them, the Now platform, which is the platform of platforms for the workflow, which includes services in the IT workflows to transform your business with workflows that optimize productivity and resilience, customer workflows to connect your customer operations to boost loyalty, and employee workflows to create connected and engaging experiences for your employees, and the creator workflows. Build connected cross-enterprise workflow applications fast. Let me show you a few clips. One of them on May 2018, John Danaho, which was the CEO of ServiceNow then, explaining what they do. And then I'm going to show you Bill McDermott, the current CEO, talking in May 2021, a few weeks ago, explaining ServiceNow as well. And again in December 2019 with Jim Cramer explaining ServiceNow.
How should we be thinking about the next great enterprise software company?
So I think this is a really important question, Dave, and I look at it through the eyes of what I heard from the 500 customers. And here's what I heard. They're embracing digital transformation. They're embracing cloud. They're embracing cloud at the infrastructure level, figuring out their data center strategy and how much they embrace public cloud. And then at the software platform level, they're saying, we want to have 4 to 6 strategic platforms. And often it's the born in the cloud platforms. Often it's Salesforce and Workday and ServiceNow, and maybe Office 365 or Google for email or communications. Maybe if they have a supply chain, SAP. And they're saying, I want those platforms to work well together. So no one platform should be claiming they can do everything. Each of us needs to figure out what's our role and how do we work with one another. And our role, ServiceNow, I'm proud to say, is one of those strategic platforms. As I said earlier, people see our capabilities as being connective tissues, helping to pull those platforms together.
Why is it? Because we are truly a platform that spans the entire enterprise. When you think about modernizing IT, or giving your employees a great experience, or reinventing customer service in a direct-to-consumer world, or building these new applications so business people and engineers can come together to change the game in days and weeks, not months and years, you're thinking ServiceNow. So this is a true enterprise software company, and there's not a lot of them around.
No.
If you look at most of the brands today, they're very departmental. And John, these islands of innovation are killing companies. They want a platform where they can glue all this complexity together and run a great business.
But you can take that platform in a million ways now, can't you?
That's the big thing.
Right.
The beauty of this platform is it started out with IT.
Right.
And of course, it's the standard in the industry. Everybody knows that.
Right.
But it goes into human capital management, customer service management. Think about financials. One of the CIOs today of a major bank said to me, I view it as my digital assistant. Of course, there's big transactional systems, but I need one that gives me my information on a dashboard. on my phone so I can make decisions in real time. This is also true for governance, risk, compliance, anything having to do with running a company. We can do it simple.
Oh, but Bill.
Well, I hope that you have a better understanding of what ServiceNow does. Let's go to the numbers. In the first quarter 2021 results, 30% growth year over year on revenues, 97% renewal rate, 4.4 billion current remaining performance obligations. And this, they define it as represents the contracted revenue that has not yet been recognized. And when they talk about current remaining performance obligations, or CRPOs, represents the RPOs that will be recognized as revenue in the next 12 months. And if we go to the fiscal year 2020 results, 4.3 billion in revenues, 32% of growth, and also 4.4 billion in current remaining performance obligations, the same as the first quarter. And if you see here, this is the total remaining performance obligations of 8.8 billion here, 32% year-over-year growth. So these are great numbers. And the remaining performance obligations over time, we see that they are growing quite fast. Here we have the total, 8.8, 4.4 and 4.4. Let me show you now an interesting graph that shows annual contract value for customer cohorts of every year for the last 11 years. You see it's growing 134%, 128%, 93%. What this number means is the following. Let's see, for example, for 2010. 2010, they take all the clients of 2010 and they say the number of annual contract value of that year is going to be 100 million. And then they compute in the first quarter of 2021 the same number of clients, that cohort, and they say how much money they are spending in annual contract value at the first quarter of 2021, 1.5 billion. So that means 15 times what these same clients were spending in 2010. So the way they calculate the growth, the annual growth, is the difference divided by 11 is 134 million per year. And this gives 134%, which is this number. And each of these numbers is calculated that way. But what this graph shows, and the fact that they are decreasing, is that every client will be growing the way the amount they spend in annual contract value exponentially. Because if you see 134%, then a year later they have accumulated 128, a year later they have accumulated 93, and so on and so forth. That means that the clients are so happy with the ServiceNow services that they come back every year contracting more services or with bigger contracts, which is great to see. And this happened also at the end of 2019, as you can see, and also at the end of 2018. So it's been happening consistently in the history of the company. And here we have expansion of customer relationships. They show the number of clients, this bar here, that have number of customers with ACVs greater than 1 million. So you can see 720 here, the first quarter of 2019, and the first quarter of 2021, 1,146. And not only they are growing, but also they are contracting more. As you can see, the average is also increasing, 3.4 million as an average from 2.9. So these are great measures of growth that if we go back a little bit further, we can also see, and you can also see the growth. which is quite substantial. It shows a company that not only is growing, but it shows customers that are very happy with the services. Net new ACV's contribution, this bar here is IT workflows. This one represents customer employee workflows, and this one represents creator workflows. And what I want to show you here is that these are the new services, and this is the old service. You can see how the new services are gaining traction. I want to show you also here something interesting from the fourth quarter of 2019. 19 of the top 20 deals included 3 or more products. And if you see the dark green, which is 15 clients, 5 or more products. The renewal rate is awesome. As you can see, the last 5 quarters, the previous 5 quarters, 98%, 99%, the previous 5 quarters, 99%, so it's really consistently high renewable rate. And I want to show you something regarding the mix geographically. North America, 2/3, Europe and Middle East, 1/4, and Asia Pacific, 10%. If you see, it's quite consistent along these last 5 quarters, and if we go further back, it's also consistent. So that means that every region is growing at the same pace. Let me show you the income statement at a glance. The revenues grew 50% per year, which is amazing. And if you see here, gross profit, the yellow, and the operating profit was negative up to a couple of years ago, became positive. And also the EBITDA, we see the same, positive from 4 years ago. This is the gross profit. It's improving, which is good. And the operating margin, you see negative only up to 4% is now and 1.2 last year. This is all calculated based on total revenue, which is GAAP. But if we see the billings, is GAAP revenues recognized plus the unbilled receivables, deferred revenue, and customer deposits. So it is a broader measure of revenue. It's more telling of the business, of the reality of the business. So if I change that, the billings instead of revenue, but I keep the costs, you see that the operating income is positive since December 2015. The cash flow is also has been growing quite fast, and capital expenditures to revenue are in the roughly 10 to 9%, 10%. And if we see the operating performance, return on invested capital adjusted is quite high, and compared to the weighted average cost of capital is really good. Gross margins and operating margins and the like I already mentioned. And here in the marketing and general and administrative, we see that it's slowly improving. Research and development is staying at the same level, which is also good, because it means that they are still spending at the same pace as the revenues increases, and overall it's slightly improving. That would be past performance, and I think it ticks the box, let's say. Let's now go and see management. In management, I like to see the way they allocate capital, that the compensation is aligned with shareholders, stock ownership by insiders, dividend policy, and long-term vision. Let's go and see capital allocation. Well, I already showed you in a table. This is in a graphical form, the return on invested capital. It's much larger than the weighted average cost of capital, so all this blue means value creation. And then the use of cash flow, they are not paying dividends, they are not making large acquisitions, but mostly has been grown organically, and they are not issuing any shares, so other than for compensation and buybacks, they are not making any buybacks. So the only use of cash really is to invest in the business. So let's go and see compensation aligned with shareholders. This is the base salary, which is decent for a company like ServiceNow. The performance-based cash incentive, which, as you know, I'm not fan of, especially because they are quite complex. But if you see here, I want to show you the performance-based cash incentives in 3 metrics. One of them is the net new annual contract value, the other one is the free cash flow margin, and the other one is the net expansion rate. This net expansion rate is how each customer is growing their own contract value. So I think that it's important because these are the figures or the key metrics that management see as the drivers of value for the company. And here there's another good thing that they show is that if the target is not met at least 85%, then they will get 0. And if it's met up to 85%, they will get 50%. So I think that this is good way to motivate the management. And then they have long-term incentives, 80% of which is performance-based. Performance-based stock units are based also again in net new annual contract value. So annual contract value is new annual contract value is one of the key metrics for the company. And again here they must meet 85%, otherwise they will get 0. So this I like. This is the compensation, the table, and you see the total here. This is similar to other companies of this size. Now let's go to stock ownership by insiders. They ask for 3 times the salary for the CEO and the others 1 time. It's quite low, but what matters, I think, is not what the company is requesting, but what the executives have in shares of the company. So let's look at that. If you see here, William McDermott, CEO since October 2019, has 21 million. This is the founder, 230 million. And then we have dividend policy. They are not paying any dividend. This is something I like. And long-term vision, I don't see anything that make me think that they are not long-term oriented as a management. So, okay, that is management. I think management passes the marks. Let's go now and see competitive advantages. I see 3 different advantages: switching costs, structural advantage, and intangible assets. Let me explain switching costs first. Switching costs is an advantage that companies have when it becomes costly or risky for its customers to switch to the competition. The more a customer relies for its daily operations on the services that the company, like ServiceNow in this case, offers, the stronger the switching costs advantage. Let's analyze this table here that I showed earlier, where we have the number of services that the 20 largest new customers contracted with ServiceNow. We see here 19 of the top 20 deals included 3 or more products, and 15 of the top 20 deals included 5 or more. Only one customer here, customer number 19, included just 2 services. As we know, the more products a company has, the more ingrained the relationship with ServiceNow and the harder for the company to switch. But also as important, or maybe more important, this shows a product offering of the greatest quality, because the only way to achieve switching costs advantage is by having a great product. And if we check these other graphs that I showed earlier, all of them show a product of great quality and value for the customer. For example, if we see renewal rate from December 2015, it has always been between 97 and 99, which is amazingly good and consistent. If we see the customer cohort growth that I showed you earlier, we also see great value for customers and great quality of the product, and in the average of annual contracted value of customers. So this is all information showing a great product. Another advantage that I see is the structural advantage. And here I refer to the compatibility that ServiceNow software has with all other competing products. As you heard the CEO explain some minutes ago, ServiceNow is the fabric that allows all other services to work together. The position of being the platform of platforms is, in my view, a durable competitive advantage. And lastly, intangible assets are coming from technology and brand. Again, I think it's not easy or even possible to replicate the technology that ServiceNow has, because they have built it organically. So it has been growing with compatibility in mind, and that's impossible to do via acquisitions. So they have a great advantage here. And this shows in the brand that they have, with 85% of the Fortune 500 companies as happy clients of ServiceNow. Okay, so that would be the end of competitive advantages analysis. I think that ServiceNow has great competitive advantages. That ticks the box. Let's go to financial position. Let me show you the balance sheet. This is cash and cash equivalents and short-term investments. Excess cash is only this part. Excess cash is 1.4 billion. If we go to the liabilities, we see that current portion of debt and then long-term portion of debt and operating lease liabilities. This make what I call total debt, and total debt is 2.13 billion. If we take total debt and subtract excess cash, we get the net debt. And if you compare net debt with EBITDA of 500 million, almost, it's 1 time roughly, and with free cash flow is half. So it's really a great financial position, and they have a very conservative balance sheet. So that would be financial position. I think it's a great financial position. Let's go to projections. Okay, in projections, let me show you first the revenues, and this is the past, and this is the revenues that I am forecasting. If you see the growth that they had been having in subscription and in professional services, what I do is I take them and I extend that in the future. I start with 31% here, which is roughly the same as they have been having in the past, and I keep lowering it slowly. And in professional services, I take somewhat the average of the last 4 or 5 years and do the same. I extend it slightly, reducing it. If you see the result of I get 23% of growth for subscription, 10% for professional services, and that means 23% for total revenues on a compounded annual growth rate, which is much smaller, half of what they have experienced the last 10 years. But I think, of course, this is not sustainable, but this is quite possible. And here, let me show you a clip of McDermott again, talking about the projections that he is making in terms of sales and in terms of market for ServiceNow for the next 5 years. And you'll see that he talks about 15 billion in roughly around this time. And so it's consistent with what I am forecasting here. Let's hear the CEO, Bill McDermott.
ServiceNow CEO, Bill, good to see you. So you had laid out a plan for 10 billion in revenue in 3 years. Now you say 15 billion in 5. Ambitious, I guess, should be encouraging to investors. It involves expanding your total addressable market. How?
Yesterday we laid out a bold plan, and the real issue here is how big is this addressable market? Digital transformation in the next 3 years will be an 8 trillion market. Our space is 175 billion.
Okay, and in terms of operating income, this, as you can see, is the past. And I'm going to use this as the basis to project the next 10 years. So this is what I'm doing. This is my projections, and I'm leaving here the last 3 years so that we see what's happening. In research and development, I am keeping it roughly constant, which is what has happened in the past. In sales and marketing and in general and administrative, what I'm doing is taking this number, and this one I'm keeping it constant because it has kept roughly constant, even though it has been reducing, but I am being conservative. And this one I'm reducing it slowly. And that gives me the operating income and the operating margin. And these are all GAAP numbers. These are not adjusted numbers. We also have the EBITDA, subtracting depreciation and amortization, and this metric I'm going to use for my valuation, this number here, which is the one in December 2030. Let's move now to the free cash flow, and here we have the past free cash flow and the future. And what I'm doing is if you see the growth has been very high, and lately in the 20, 50, 44%, what I'm doing is I'm growing it at 25% and then coming down all the way to 15%. That gives me an operating cash flow growth of 19.9% on a compounded annual growth rate, which is less than half of what they have experienced in the past. And if I assume a capital expenditures to revenue of 9% coming down to 7%, similar to what they are having in the last 5 years, I will have free cash flow of these amounts that will be growing at 19.8% on a compounded annual growth rate, which is much smaller than the past 10 years. And this number here, 8 billion, is what I'm going to use for valuation purposes. And so now we can go to fair value and IRR calculation. So with these two numbers, the ones that I've just showed you, EBITDA at December 2030 and free cash flow, I will use a ratio of 35 times for EBITDA and 32 times for free cash flow. Let me first explain you how I come with these ratios. If you see enterprise value to EBITDA for the company, it has been, when it has been positive, it has been over 100, but this is because this company is in the early stages of growth. So we can see other companies in the peer group: Adobe 47, Autodesk 88, Intuit 45, Salesforce 58, 300 for Workday. So many of the companies that are in the peer group have a very high enterprise value to EBITDA, but I'm going to use 35 because the way the company is going to be in 10 years time in terms of growth and maturity, let's say, I think 35 is a reasonable number. And in terms of free cash flow, 32 I'm using, and this comes from, if I'm using a weighted average cost of capital of 8 and growth in perpetuity of 3, and project free cash flow from 2030 to 2040 in this way, growing 15% all the way to 5%, it will give me an enterprise value of 35.94 times the free cash flow of 2030. So this would be like 36 times, but I'm using 32 to be a bit more conservative. So that would give me this enterprise value, and with that enterprise value, subtracting net debt that I am assuming, I get the market capitalization. And with the weighted average shares outstanding, which is the same number of 2021, I get the price, and the average of the two is what I'm going to use as the target price for 10 years. With this target price, we can calculate the internal rate of return. So if we will have our cash flow, if we buy at today's price, roughly 560, and sell at my target price in December 2030, and then I add free cash flow per share adjusted, and the adjustment is coming from stock compensation, which is not part of free cash flow. I subtract that from cash flow. So this free cash flow will give me this IRR. If I buy at 559, I will get 12% IRR. And to get to a 10% IRR, 670. So we can say that 670 is the fair value for ServiceNow from my analysis. Okay, that concludes my analysis. I hope you liked it. Please give it a like to the video if you do. I hope that you learned something. As you see, ServiceNow is a company that I really like. It's not very well known by retail investors, and I think it should be in your radar, if not in your portfolio. So, well, if you haven't subscribed, please do so, and click the bell if you want to get notified in the future. I'll see you in the next video, probably in a couple of weeks. Thanks very much for watching. Bye bye.